Hi there, a very happy new year to you and a very happy Lunar New Year as well. We're into the Year of the Rabbit, so I hope that it's an excellent one for you. In this video I'd like to share with you a bit of an update on what we saw in the fourth quarter of 2022 and also across the year when we look at global markets. It was certainly a year not without its challenges. We saw everything from supermarket and theme park lockdowns in China. We saw the price of lettuces getting so ridiculous that KFC tried to swap out lettuce with cabbage, which didn't go down terribly well. We've seen changes in leadership, very questionable changes in some countries that both didn't last terribly long and led to some interesting economic policies. And we've seen one of the sharpest increases in interest rates on the back of inflation than we have seen in decades. Naturally, this meant that investment markets tumbled. There were very few safe places to invest in 2022. We saw the Nasdaq, which is the tech-heavy sector, down around 33 to 34%. We saw the S&P 500, so the largest 500 companies, down around 20%. The Australian market held up relatively well, which was really driven by the fact that the Aussie market is heavily reliant on resources, banking and property. And thanks to the Australian government, they threw an awful lot of money at various housing subsidies, and that kept the real estate sector well and truly afloat, although we did see that change quite aggressively, particularly in the second half of 2022 with the collapse of a number of builders. Now, it's been all eyes on inflation, and we have been watching inflation as we enter 2023. A little more on that later, but thankfully we are seeing this data head in the right direction, and very likely we will see a reasonable year ahead, although not without its volatility, into 2023. Now, 2022 we've seen a sharp sell-off in quality and the garbage when we look at investment opportunities, and we expect that more of this will continue into the new year. But what it does mean is that it's created some excellent opportunities for investors with the right time horizon, investing in quality assets right across the globe. So in this update, I'd like to share with you a bit about what's happening in Australia, what's happening in the US, Europe and the UK, and also Asian markets. So let's get started and dive right in. Back home in Australia, as I mentioned earlier, it was a relatively strong year compared to the rest of the world. We saw real estate propped up, we saw the financial sector propped up as a result, and naturally our resources, both agricultural commodities and also iron ore, gas and coal, had a relatively strong year as well. Now, we saw obviously a sharp increase in a number of commodities and resources on the back of the Russia-Ukraine conflict, and whilst we expect that some of these prices will soften in 2023, they will remain, our expectations are, inflated compared to where we were over previous years. So this is very likely to continue. The inflation data that we've already seen in Australia is suggesting that the fourth quarter of 2022 will be the peak of inflation. Now, it doesn't mean that we're going to head back to the RBA's target of 2 to 3% anytime soon. Inflation is very likely to remain stubbornly high, but it does mean that we are gradually going to head in the right direction. Global economic growth is slowing down, the Australian economy is slowing down, unemployment is rising, as it should, as it needs to. Whilst it sounds like a harsh thing and negative for unemployment to be rising, when we're sitting at unemployment levels that start with a 3 or even a 4, that is putting far too much pressure on wages, and it makes it incredibly difficult for companies to find and retain the right talent. And naturally that has an impact on business confidence. Now, what does all of this mean for interest rates in Australia? Well, given that inflation has likely peaked, but will remain stubbornly high, it very likely means that the RBA will increase rates perhaps 1 to 3 more times into 2023. We don't expect that we're going to see the increases in 2022. In fact, we can almost guarantee that we won't. But 1 or 2 more increases is probably about where we should sit, depending on what economic growth looks like going forward. Now, will we see the R word, the recession, announced in Australia? Look, the reality is I think we'll get relatively close, although I think we may be sheltered from it given the strength in commodity prices. At the end of the day, we're not really expecting a major impact either way. If it is announced, it will very likely just act as a signal for investors to be more confident to, I guess, identify that turning point and start deploying capital into the market. So either way, we feel that Australia will have a relatively strong year ahead. The Aussie dollar is also showing signs of strength, particularly given the high interest rate in Australia and the strong economy as well. We're also seeing a lot of migration pick up in Australia as well. And naturally, this is going to have a bit of a downward impact on inflation also. It's going to boost the labour market, to have a bit of an impact on unemployment, and naturally that will be good news for the Australian economy overall. So we're watching the Aussie market relatively closely. We like technology, we're watching the financials, certainly watching the resource commodity space, and expect that it will be an interesting year ahead for Aussie markets. We also expect that energy, both in the renewable and sort of alternative energy space, will do well. We also expect that the oil and gas sector is going to have a relatively good year ahead, particularly with inflation as well. So that's a bit about what's happening in Australia. Let's have a look at the United States. Now in the US, it has been all eyes on inflation, much like the rest of the world, but it's very interesting in the United States when we compare the US to Australia, the impact that the central bank has on consumers and on borrowers in general is quite different. And the reason for that is largely driven by the way that the mortgage market or the homeowner market actually operates. In the United States, most people are on a 30-year fixed rate mortgage that would typically start with a 2 or a 3, in some cases even a 1, but a very low rate that doesn't move just because the Federal Reserve increases or decreases the cash rate. So the only way that a homeowner or a mortgage holder in the United States would actually feel the impact in terms of their loan repayments would be if they sell or they try and refinance. So naturally, when the Federal Reserve is aggressively increasing interest rates, most people are not going to be interested in selling their property because it would mean a much higher interest rate on the next property that they're buying. So what this means is that the Federal Reserve has a much tougher job in many ways, a much greater uphill climb in getting consumer confidence down to a level where they're comfortable, to reduce consumer spending and encourage people to start to be more considerate with their cash balances and be ready for the year ahead. Now, the inflation data that we've already seen in January 2023 suggests that that is also heading in the right direction. Again, it will be slow. Again, we are certainly not at the end yet of the rate rising cycle. And it is also likely that we will see a technical recession announced in the United States. Again, do we expect this to have too much of an impact on equity markets or investment markets globally? The answer is no. Certainly it will have impact on the junk end of the market, but the quality investment opportunities certainly remain there, and we certainly expect that they will be great long-term investments for clients and investors in general. So that's a bit about what's happening in the US. We will be watching the next Federal Reserve minutes and meeting very closely to look at what the rhetoric is actually looking like as we head into 2023. So that's a bit about what's happening in the US. Let's have a look at Europe and the UK. Now in Europe and the UK, it is a relatively similar story to the US. The European Central Bank has suggested that interest rates will continue to rise, which should come as no surprise to anyone. Naturally, there are concerns around Russia-Ukraine, the supply of energy, particularly if winter is longer and or colder than years past, and naturally this will have an impact on energy prices and geopolitical tensions in the region in general. In the UK, obviously a volatile fourth quarter for the UK with leadership changes. We saw Truss's very questionable economic plan, which thankfully was put to bed very quickly, although not before it had a significant impact both on the currency, the pound, and also the fixed income, the bond markets in the UK as well. So we will be treading with caution when we look at European and UK equity markets, but we do believe there are some good opportunities there. The outlook, the general sentiment has been rather bearish over the last decade. So again, we think this creates some good opportunities across a wide range of sectors in European markets in general. So that's a bit about what's happening in Europe and the UK. Let's have a look at what's happening a little closer to home in Singapore and the rest of the Asian markets. Now in Asian markets, we've seen a few interesting things, or a few interesting economic updates of recent times. We've seen the Bank of Japan suggest that interest rates will continue to rise into 2023. Naturally, there are some concerns around the humanitarian impact of China reopening, given China has been under such a tight lockdown, largely for the majority of COVID, particularly through 2022. This is going to have an impact. There will be a death toll, and unfortunately there will be casualties as a result of this. This is going to occupy the headlines into 2023, but from an investment sense, from a corporate sense, we believe that as the Chinese consumer is able to start spending again, as that confidence returns, we expect that that is going to come back with an absolute vengeance. So when we look at both domestic and international travel, luxury retail, gambling, casinos, we are going to see a very likely pickup, whilst economic growth in China isn't going to be at the double-digit extremes that we saw in the early 2000s. We do expect the consumption is going to see a significant uplift, probably over the second half or even from Q2 of 2023, just depending on how the overall reopening goes. Naturally, there will be some caution in the rest of Asia as they sort of tussle with what to do around Chinese visas, around tourism in general. But again, we expect that this confidence will flow through and we will see a greater uplift in the region overall. Singapore, Hong Kong, we're very closely monitoring both financials and real estate. We are seeing some interesting things in residential rentals in Singapore, and obviously commercial as well, as a number of companies are letting leases lapse, but there are still new companies coming in. So certainly watching this space very closely, watching what the data tells us and looking for opportunities where they are. We fully expect that things like cybersecurity around financial services and cybersecurity in general is going to have going to present some good investment opportunities. We also expect that technology, whilst there will be quite a number of layoffs, is going to continue to do well, just given their marginal economics and their relatively low fixed costs relative to revenue growth. So we expect that there are going to be some good opportunities in Asian markets in general. So that's a bit about what's happening around the world. As I said, it has been a very challenging 2022, but we do expect that quality investments for investors with that medium to long-term horizon are already presented and will continue to be presented with some very good investment opportunities. So what does it all mean? If you're regularly contributing, at the very least seek to continue, increase it if you can. If you are sitting on cash waiting for the right time to invest, I would suggest looking at breaking that up and dollar cost averaging that over a period of time. Again, reach out and we can have a discussion around what makes the most sense for you. But again, we do expect that there are some very good opportunities at these times in these markets. I'd love to have a chat with you, so do feel free to reach out, use the link in the note, book in a meeting. I look forward to speaking with you. Thank you very much for tuning into the update, and I look forward to speaking with you soon.